and a good weekend as well ahead. Well, let's move on. Let's get chatting with Aman Chowhan, fund manager at Abakkus Asset Management, who joins us on the show. Hi, Aman. What a good time it's been, right? You guys were buying when the markets were not doing much till March 2023, and the last 3.5 months has been absolutely brilliant. Portfolios are looking good. Your clients must be thrilled. What's the strategy from here on? Have you all raised cash in select stocks, or are you all still deploying? What's the strategy from here on?
No, we have not raised cash. So we are holding on to what we own, and the inflows that we keep on getting in, that we are gradually deploying. So it's not that we are deploying that money that comes in overnight. So we are deploying 60-70% to start with, and hopefully over the next 1 to 2 months, we would like the portfolios to be fully deployed for the new clients to come in.
Aman, hi, good afternoon. Good to have you on the show. So tell us, it's really the mid-cap market which is on fire, and people are looking for new ideas. We were just discussing one stock, JBM Auto, with our previous guest. I wanted to get your thoughts on two pockets where there's intense price action that's visible, and whether, what your opinion is. One is the one is the electronics manufacturing space, EMS. And the other is this whole smart metering business. I mean, look at what's happened to stocks. Today, again, there is GMR Power, Genus, HPL Electric has risen 100% in just 1 month alone. So just want to get your sense on some of these opportunities, whether they look exciting enough to you, and whether there's still enough on the table, or if this is a market, it's a bull market, and things are just moving too fast.
It's a combination of both. So I think this all started with the defense sector, then it moved on to railways. Now it is catching on to the utilities in the power sector, where we're seeing good amount of ordering and tendering coming from the government side. And then the spillover effect of that moves into the smaller companies who were waiting for businesses, and now they're getting these businesses, and order books are swelling up. And combined with that is the market. Last 3 months specifically, mid and small caps have been in a roll. So investor interest is also pretty high. So earlier, if you got an order, there would be a 5% price move. Now it's a 15% price move. So it's a combination of both. But fundamentally speaking, these sectors are definitely looking good, especially because the business momentum has picked up. The private spend, and more so the government spend, is picking up. And that is what is getting reflected. And it's a clear strategy from the government. They want to reduce the import bill. So anything that is imported, they would like to manufacture it in India. And that's a big boost to the domestic manufacturing sector.
Aman, I remember asking you a few, weeks back, perhaps the last time you came or the one before, about the auto sector. And autos had started doing very well. And you said the rally in autos would be a tactical rally, because raw material prices are softened, therefore margins are going to, margins are looking up. But there is a section on the street which believes that after more than 5 years of a downturn, there is a structural up move in auto. Why are you not convinced about that thesis?
There is a move, but as I mentioned last time also, we are pretty positive on the commodities. So if we are positive on the commodities, we feel that it is a better bet to invest directly into commodities than into autos, because a higher commodity price will have a negative margin impact on the auto sector. So while demand is picking up, but at the same time, if you look at different demand, the rural demand in India, there is a slowdown definitely there. You see that in the two-wheeler demand also. So overall, everything is doing well. Economy is doing well. The autos also doing well. But we feel it is relatively better to own a metal stock where we are more bullish than to own an auto stock.
Okay, fair enough. What about IT? In your portfolio, I think IT holding is about 10%. So it's slightly lower than the overall weightage of the IT stocks in the Nifty. So in that sense, you've got an underweight call on IT. But IT's today 4% up move has been dazzling. It's the best one-day move since September of 2020. And Hormuz also tells me that the IT index has added 1 lakh crore to its market capitalization. Do you think IT has made a bottom? And maybe it's a tactical trade, but would you look to up your weightage or take a tactical call on IT?
Yeah, so we were always positive on IT, and we turned neutral a few quarters back, and we continue to maintain that stance. So we like the sector, but near-term growth visibility is there, but it is a decelerating sector for us. That's the reason we are not significantly increasing our share in IT. So we continue to own what we have, and no plans to sell that. we feel this trade is more to do with what has happened in the Nasdaq and the way US markets are rallying. And the rub effect of that is visible both in the IT sector as well as the new age stocks that are also buzzing along with this. Definitely, from a growth perspective, I feel 1 and 2Q would be the bottom quarters, and post that things will start to look up. And hence, we continue to own what we have, but not increasing the exposure as of now.
Well, it decreased your weightage on any particular sector, some kind of taking some money off the table in any sector for a rejig, I mean reallocation?
Chemicals, this is where we feel there is a good possibility of a PE de-rating happening, because clearly there are pockets in the chemical sector where both demand as well as margins have taken a hit. And in that scenario, we feel that a 30-40 P might not be sustainable. And hence, we have reduced our exposure in the chemicals. That's, I believe, would be the major sector where we have reduced our exposure.
Okay, so that's your take on some of the chemical names. Aman, so, give us a broader overview. I mean, how are you sizing up the market right now at current levels, 19,500 thereabouts? What's your expectation? I mean, second half of this year, can we keep getting this kind of, momentum on the upside? Do you keep expecting particularly mid caps and small caps to do as well as they have been? Where would you put incremental money?
For us, it's more of so where the valuations are more comfortable, whether it's a large cap or a mid cap. So the incremental money for us is flowing into both large and mid caps. Definitely, what has happened in the last 3 months, I'm not expecting the same thing to get repeated in the next 3 months. November, December is when we have state elections. So while market right now is predominantly focused on central elections where Modi will come for re-election next year, till then they feel it's all well. I feel very soon market will start looking at the state election also, because MP, Chhattisgarh, Rajasthan, these are all 3 big states, will be getting into election mode. And markets would like to take a breather before that, look at how the exit polls, how the trends are, and then take a fresh look. So till that time, for the next few months, I think markets are in healthy shape, post which we expect markets can take a pause ahead of the central elections coming in.
Aman, since you brought it up, I have to ask you this. What is the best election play? Because you've got to have that play now in your portfolio in the run-up to, next year. So I don't know, I mean, home improvement stocks, pipe coming. How do you play the general election and the spends that are expected?
So typically railways, power sector used to be the one, but railways are already done very well. I feel EPC companies, infra companies would do well, because even if there's a spend on an airport or on a road or a civil infra or urban infra, these are the companies that are going to execute that. So that is one segment which is clearly looking good. Valuations are also reasonable. These companies are trading around 14-15 times 1 year forward earnings. Most of the companies have learned from the past cycle that they have to manage their working capital well. So they are keeping a good tight budget as far as the working capital is concerned. So this one sector is definitely what we are gunning on ahead of the elections, and a good proxy to a favorable election outcome.
We'll leave the conversation here. Thank you very much for joining in. Need to get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls for the weekend.